Why your annual bonus goes into the riskiest investment you own. Mental accounting. Good morning, investors. I want to start today with a simple observation, and I want you to think about whether it applies to you. Your monthly salary arrives. How do you invest it? Most likely, the same way every month. Your SIP runs automatically, maybe a recurring deposit, a disciplined, structured plan that you set up and follow without much drama. Now think about the last time you received an annual bonus, or a tax refund, or money from a matured fixed deposit, or profits you redeemed from a fund that had a good run. How did you invest that money? Was it the same way, same fund, same category, same discipline, or did it go somewhere different, somewhere slightly more exciting? A thematic fund you had been watching, a small cap NFO that looked promising, a sectoral bet on a theme everyone was talking about. If the answer is the second, you have experienced one of the most quietly expensive biases in all of investing. And it was identified and named by a Nobel Prize winner 40 years ago. The research. Richard Thaler, Nobel Prize winner in economics 2017, spent decades challenging one of the most fundamental assumptions in all of economics. That assumption is called fungibility. The idea that money carries no labels, that 1 lakh rupees earned from your salary and 1 lakh received as an annual bonus and 1 lakh redeemed from a mutual fund profit are in every meaningful sense identical and should be treated identically when making investment decisions. Standard economics assumed this was obvious. Of course, money is money. Of course, a rupee is a rupee. What difference does it make where it came from? Thaler spent his career showing that this assumption, while logically correct, is psychologically completely wrong. In his landmark 1985 paper, Mental Accounting and Consumer Choice, now one of his most cited works in all of academic economics, with over 6,000 citations, he demonstrated something that every investor needs to understand about themselves. People do not treat all money the same. They mentally divide their money into separate accounts, almost like invisible envelopes in their minds. Each envelope has a different label. Each label comes with different rules, different risk tolerance, different emotional weight, different psychology. He called this mental accounting. Your salary goes into the regular expenses envelope and the long-term savings envelope. Your bonus goes into a different envelope entirely, one that feels lighter, looser, more available for risk. Your fund profits go into yet another envelope, one that feels like house money, like winnings at a game, like money that was never really yours to begin with. And each of these envelopes gets invested differently, even though the money in each one is equally, identically, completely real. How it shows up in your portfolio. Let me paint a picture that I think will feel very familiar. Your monthly salary arrives on the 1st of the month. Your SIP deducts automatically on the 5th. Large cap fund, flexi cap fund, maybe a debt fund for stability, disciplined, boring, exactly right. Your annual bonus arrives in March. Suddenly there is a conversation happening in your head that sounds very different from the salary conversation. This is extra. I could afford to take a bit more risk with this. Let me look at what has been performing well recently. And then, almost inevitably, the bonus goes into a thematic fund or a small cap NFO that everyone in your office is talking about, or a sectoral bet on a story that sounds compelling. Why? Why does the same investor who puts his salary into a disciplined SIP put his bonus into a high-risk thematic fund? Not because the bonus is worthless, not because the risk is actually smaller, but because the bonus arrived in a different mental envelope, and that envelope feels like it comes with different rules. It does not, but it feels like it does. And in investing, that feeling is expensive. The data from India. This is not a theoretical problem. The Indian mutual fund data from 2024 shows mental accounting playing out at extraordinary scale. Sectoral and thematic funds attracted 1.4 lakh crore in 2024, representing 42% of all active mutual fund flows in the entire year. Manufacturing fund AUM alone grew from 7,700 crore to 32,200 crore in just 6 months. PSU and infrastructure funds were delivering returns exceeding 55% over 12 months, and the money was pouring in. Dhirendra Kumar, CEO of Value Research, one of India's most respected independent mutual fund research platforms, noted publicly that investors would not be worse off if they simply ignored sectoral and thematic funds entirely. Yet 42% of active flows went there. The analysis was not driving those decisions, the mental accounting was. Bonus money, windfall money, profit money, fund money, each arriving in a different mental envelope, each feeling like it came with different rules, and each ending up in higher risk, lower diversification products that the same investors would never have chosen for their monthly SIP. The simple test. Here is the test I want you to apply to every investment decision, regardless of where the money came from. Ask yourself honestly, would I make the same investment if this money had come from my monthly salary? If the answer is yes, invest with confidence. Your decision is based on analysis, not on the label attached to the money. If the answer is no, pause, because mental accounting is making the decision, not your financial plan, not your risk profile, not your long-term goals, just the invisible envelope the money arrived in. The real lesson. Richard Thaler proved in 1985 what every honest investor eventually discovers. We do not treat all money equal. We treat it according to where it came from, and that treatment has consequences that compound quietly over years and decades. Your annual bonus is not free money. Your fund profits are not house money. Your tax refund is not gambling chips. Every rupee, regardless of its origin, carries exactly the same weight in your future. The mental envelope it arrived in is an illusion. Your wealth is not. My WealthWise pin-up rule for today. Money has no memory of where it came from. Your investment decisions should not have one either. Tell me honestly in the comments, have you ever invested a bonus, a windfall, or a fund profit differently from how you invest your monthly salary? What did that money go into? This is one of the most universal patterns in investing, and recognizing it is worth more than any fund recommendation I could give you. I am MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube, and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealth wise.